Most people think a credit score is a moral report card. They think it tells the world whether you are responsible, whether you pay your bills, whether you are the sort of adult who deserves trust. That is not quite right. A credit score is not mainly a judgment of your character. It is a reaction to a data snapshot. And if you misunderstand when that snapshot is taken, the system can punish you even when you did what any normal person would call the responsible thing. I want to begin with that because a great many people walk around feeling confused, insulted, or vaguely ashamed about their credit when the real problem is not that they are reckless. The real problem is that they do not understand the calendar the machine is actually using. I have spent most of my life looking at systems. Markets are systems. Businesses are systems. Insurance is a system. Taxes are a system. Human beings, once you have watched enough of them around money, are really systems too. And one of the most expensive mistakes ordinary people make is assuming a system is reacting to their intentions, when it is actually reacting to their timing. The banking world is full of timing. Settlement dates, record dates, ex-dividend dates, maturity dates, closing dates, reporting dates, due dates. People hear one of those dates and assume it must be the important one because it is the one shouted at them most loudly. That is usually where the trouble begins. In the world of credit cards, the date most people respect is the due date. That makes perfect sense. If the only thing you care about is avoiding late fees and interest, pay by the due date, and you generally keep the account in good standing. You avoid the ugly interest charge, you avoid the penalty. Fine, that is useful. What many people never learn is that the due date is often not the date shaping the picture the credit bureaus receive. And that single misunderstanding can cost an otherwise responsible borrower a surprising number of points. Now, I do not say that because I think life begins and ends with a score. It does not. A credit score is a tool. Like most tools, it matters in exactly the situations where you wish it did not matter. The moments when you want to buy a house, refinance debt, lease an apartment, secure a business line, or obtain better terms from institutions that already make too much money. At those moments, a strong score lowers friction. It lowers borrowing costs. It lowers the price of mistrust. That is useful enough for me to care. A few points do not matter every day. They matter tremendously when you are borrowing 6 figures. That is when small misunderstandings become expensive. So let us take the simplest example. A person has a credit card with a $5,000 limit. He buys $2,000 of furniture. He has the cash in the bank. He is not struggling. He is not hiding from the bill. He fully intends to pay it off. He waits for the statement to arrive, opens the app, pays the full amount, and feels pleased with himself because he used credit properly and paid no interest. Then a few days later, he gets an alert saying his score dropped. Now he feels confused. He did everything right. He borrowed, then he paid. No late fee, no revolving balance carried into the next interest period, and still the number fell. That feels unfair because in ordinary life we reward the intention and the act. The system is not looking at the act in real time. It is looking at a photograph taken earlier. That is the key. Credit reporting for most ordinary people is not a live video feed. It is much closer to a monthly photograph, and many responsible borrowers keep cleaning the room after the photographer already came through. That is why the score looks worse than their own bank behavior would suggest. Once you understand that, the whole subject becomes much less mysterious. What the card issuer typically reports to the bureaus is the statement balance or something very close to the balance at the statement closing date. That is not always the same thing as what you owe by the due date. In fact, the due date usually comes later, sometimes much later. So a card can close its cycle with a large balance, report that balance outward, and only afterward receive your full payment. You and the card company know you paid. The bureau is still carrying the older picture until the next update. That older picture shapes your utilization, and utilization is one of the fastest moving parts of the score. I want to stay here because the public usually misunderstands utilization in one of 2 ways. Either they ignore it completely and assume that paying on time is the whole game. or they become so obsessed with it that they create new problems trying to optimize it too aggressively. Both errors are unnecessary. Utilization is simply the percentage of your available revolving credit that appears in use when the system takes its snapshot. If your card limit is $1,000 and the reported balance is $500, your utilization is 50% on that card. If your total limits across all cards are $10,000 and your total reported balances are $1,000, your aggregate utilization is 10%. The scoring models look at both. That is why a person can think he is diversified, because his overall number looks decent while one particular card is heavily used and still drags the score down. The machine, it sees high usage as stress. That is the whole logic. The scoring model does not know whether you are a thoughtful adult who temporarily used a larger share of a card because you wanted the purchase protection on furniture and planned to pay it all off next week. It also does not know whether you are one emergency away from a breakdown and are desperately leaning on every credit line available to you. The model reacts to patterns that historically correlate with trouble. High utilization often appears before default. So the model treats high utilization as a warning sign that is not personal, it is actuarial. If you want to understand finance well, you must get used to actuarial thinking. The system is not asking whether your reasons felt respectable. The system is asking what your current behavior looks like when translated into probabilities. That is why a person with years of perfect payment history can still see a meaningful temporary score decline after maxing out a low-limit card for a big purchase. Even if he pays in full later, the payment history remains excellent. The utilization snapshot got ugly, and the model weights that ugliness quickly because it is designed to react quickly. That is why this lever matters. Late payments can haunt you for years. Utilization can change in a month. That is one reason it is useful. It is also why it confuses people. A score can drop quickly and recover quickly, which makes the entire thing feel arbitrary when you do not understand what is being measured. I dislike unnecessary confusion around money. It causes people to form superstitions. Then they stop using tools correctly. Then they build weak structures out of fear. I would rather people understand what the machine actually wants. If you can stop letting the photograph always catch you on your messiest day. Now, there is a temptation at this point to say, fine, I will just pay everything as soon as I spend it, get every card to zero, and the problem disappears. Not so fast. This is where the second misunderstanding appears. People discover that reported balances matter, then conclude that reported zero on every card must be ideal. The world of scoring is seldom that elegant. The models are trying to assess whether you can handle credit responsibly. If every card reports zero all the time, the system can stop seeing active use and start seeing inactivity. That can be slightly worse than very low responsible use. It sounds absurd when stated plainly. How could using no credit be slightly less impressive than using a tiny amount of credit? Because the model is trying to score behavior. If there is no recent revolving behavior visible, there is less evidence of current management. This is one reason the very highest scorers often report not zero, but a tiny balance on one card while the others sit at zero. All zero except one. People now give it little acronyms and turn it into a ritual. Fine. The principle itself is not crazy. You want the bureaus to see that you use credit lightly and control it effortlessly. That is a better signal than appearing to disappear completely. Again, the system is not judging your soul. It is reading the signal you create. The sweet spot for ordinary high scorers is usually not 30% utilization, certainly not 50, and absolutely not 80 or 90. It is often single digits. Under 10% is usually strong. Under a few percent on total lines can be even stronger when you are approaching a major credit application, and a tiny reported balance on one card can be enough to keep the account activity. The distinction between reporting a small balance and carrying an interest bearing balance matters here. Many people confuse the two. They think if they let even $10 report, they must then pay interest on that $10. Not if they are using the card correctly. The statement can close with a small balance that gets reported. Then you pay that statement balance by the due date. No interest. You created the signal without. That is simply understanding the sequence. And sequence matters. This is why I say the due date is not enough. The statement closing date is the calendar lever. Most people never learn to respect. A person can have autopay set up perfectly to pay the statement balance each month and still report higher balances than necessary because autopay is designed to prevent lateness, not to optimize the reported snapshot. Autopay is a fine servant and a poor strategist. It solves one problem. It does not solve all problems. That is true of many good systems. You still have to understand what they were built to do. If you care about maximizing your score ahead of a mortgage, an auto loan, a business application, or any other important underwriting event, then you must know when the card closes, not only when the bill is due. That usually requires opening the actual statement and finding the billing cycle end or closing date. Then you work backward. If the cycle closes on the 15th, you do not wait until the 20th due date next month to display your virtue. You push the balance down before the 15th, so the system captures the better number. That is the simple mechanism: pay before the statement prints, not only after it arrives. Now, because I dislike advice that floats around without practical shape, let me make this concrete. Suppose the card closes on the 15th of each month. Suppose your current balance on the 12th is $800 against a total limit of $1,000. If you let that ride into the closing date, the reported number may show 80% utilization. The model will not love it. Now suppose on the 12th or 13th you push $790 to the card, leaving $10. The statement closes on the 15th with $10. That is what gets reported later. Before the due date, you pay the remaining $10. No interest. Completely different signal. The same borrower, the same income, the same overall financial reality. What changed was timing. That is why I care about systems. A strong financial life often depends on understanding when the system takes its snapshots. The tax system does it, the insurance system does it, the estate system does it, and the credit system does it too. Once you understand the snapshot, you can stop being surprised by it. Now let me tell you where people go from useful control into foolish obsession. They discover this timing principle and then start cycling credit far beyond what the issuer likely intended. They spend up to the limit, pay it down, spend again, pay it down, spend again, all within one billing cycle, trying to use a $1,000 line as if it were a $3,000 line. To the customer, this can feel clever. To the bank's risk department, it can look abnormal. Banks grant limits for a reason. That reason is not always generous. It reflects how much exposure they want to permit with you. If you keep forcing far more volume through the card than the line suggests, you can trigger exactly the kind of attention you do not want. Reviews, freezes, requests for documents, occasionally closures. This is where the average person makes a classic error. He learns one useful rule and then starts using it beyond the domain where it was intelligent. I have always believed that one of the signs of maturity is using a tool up to the point where it helps and then stopping before vanity takes over. If your spending regularly exceeds the card's limit by enough that you feel forced to pay it down mid-cycle just to keep using it, you likely do not need a clever timing trick. You need a higher limit or a more suitable card structure. That is the honest answer. Higher limits make utilization easier to manage naturally. A $2,000 monthly spend on a $20,000 line is only 10%. You hardly need a hack at that point. The structure itself becomes calmer. That is often what you want from money. Calm, not cleverness. There is another quiet mistake people make around credit structure. They close old cards because they want simplification. Now, I understand the instinct. Too many accounts can feel messy, but an old unused card with a good history and a decent limit can be quietly helping you. It expands the denominator in your utilization ratio. It lengthens the average age of your accounts. It provides extra room for the same monthly spending to look smaller relative to total available credit. Those are useful functions. Close the account. and the total available credit can shrink immediately. Your debt stays the same. Your utilization percentage rises. The very act meant to simplify can make the picture look worse. Again, timing and structure matter more than people think. If there are annual fees that do not justify themselves, if the issuer relationship is bad, if the product is genuinely harmful for your habits, fine. But many people close healthy old lines without understanding what those lines were quietly doing for the score. In finance, what looks unused is not always useless. Sometimes it is ballast. And because the modern world likes to move faster than truth, let me say something about newer scoring models too. Not every system will forever remain this simple monthly snapshot. Some newer models look more deeply at trending behavior across time. If a borrower repeatedly maxes out a card and then brings it down at the last minute, the model may eventually become more sophisticated in reading the pattern. That does not invalidate the usefulness of understanding statement timing. It simply means that no tactical move should become an excuse for living too close to the edge. I do not want people using this knowledge to cosmetically disguise real stress. I want them using it to avoid being unfairly misread when their actual behavior is already responsible. That is a very different thing. The good borrower is not trying to manipulate the system so he can look safe while secretly being unstable. The good borrower is trying to make sure the system sees the reality that he is already stable. That is the ethical use of the insight. I care about the distinction because the world has too much financial advice built around cosmetic cleverness and not enough built around structural strength. Structural strength still matters most. No timing trick compensates for chronic overspending. No reporting optimization rescues a person who keeps carrying expensive revolving debt. No tiny reported balance saves a borrower whose cash flow is consistently one emergency away from unraveling. Credit optimization is useful. Credit reality is more important. That is why I would think about this in layers. First layer, never miss a payment. That is basic. Without that, the rest is theater. Second layer, do not carry interest, bearing consumer balances unless you have absolutely no other path and are actively escaping them. Third layer, know the statement dates and keep reported utilization sensible. Fourth layer, preserve strong old lines when they are useful and inexpensive. Fifth layer, ask for higher limits carefully when your actual income, history, and behavior justify them because a stronger structure reduces the need for constant tactical adjustments. That is adult credit management. The public often wants magic. I want sequence. Sequence is what changes financial outcomes. Now, because I cannot resist talking about psychology, let me mention the most dangerous part of this whole subject. Shame. People feel shame when the score drops. And shame is a terrible teacher because it encourages secrecy and emotional reactions rather than calm diagnosis. A person sees the score fall, feels accused, and then either panics or avoids looking. Neither helps. The better response is almost clinical. What changed? Was there a hard inquiry? Was there a late payment? Was there a jump in utilization? Was a card closed? Did an old line disappear? Did one low-limit card report an ugly percentage? These questions turn shame back into analysis. And analysis is nearly always where improvement begins. I have never seen much value in self-condemnation around money. It wastes energy and obscures arithmetic. I would rather a person calmly look at the report and say, the system photographed me at a sloppy moment, and I now know how to clean the room before the photographer arrives next month. That is progress. There is also a life lesson here far beyond credit cards. Many systems in life do not reward your private intention. They reward the visible signal they are designed to measure. If you do not understand the measurement, you can keep doing the right thing in the wrong sequence and wondering why the result looks wrong. Taxes work that way. Hiring decisions often work that way. Public markets work that way. Credit absolutely works that way. This is one reason I have always preferred understanding the machinery instead of merely memorizing the slogans. The slogan says, pay by the due date. Fine, useful. The machinery says the statement closing date may matter more for the score. That is the kind of difference that saves money, and saving money on borrowed money is often one of the highest return forms of intelligence available to an ordinary household. A few dozen points may not matter when you are doing nothing with them. They matter a great deal when your family is financing a house. They matter on a car loan. They matter on insurance pricing. In some contexts, they matter in a landlord screening process. They matter in the cost of mistrust. The world charges a premium to people who look riskier. Do not volunteer to pay that premium because you misunderstood one calendar date. That is too silly a reason to lose money. Now let me compress all of this into the simplest usable picture. The due date prevents interest and lateness. The statement closing date often determines what gets photographed for the bureaus. Your utilization is the percentage of available revolving credit that appears in use on that photograph. High percentages signal stress. Very low but non-zero responsible use often signals control better than permanent zeros. A tiny balance reported is not the same as carrying interest, so long as you pay the statement balance by the due date. Autopay keeps you safe from lateness, but does not necessarily optimize what gets reported. Old healthy credit lines often help more than people think. Trying to cycle a line far beyond its intended monthly use can make you look strange to the bank. The goal is not to game the system into The goal is to make sure the system accurately sees the strong story that is already true. That is how I would think about it. Not as some mystical hack, as calendar literacy. Calendar literacy is worth more than people know. A person who understands when the machine counts, when it closes, when it looks, when it measures, and when it settles can often improve his financial life without making a single dramatic sacrifice. He merely stops acting a few days too late. That is a wonderful kind of improvement. Subtle, boring, and economically meaningful. The best improvements often are. So if your score has ever dropped after you paid in full, do not take it as a verdict on your responsibility. Take it as proof that you were reading the wrong clock. Then find the right one. That is all the system was asking of you in the first place.